It is December 23, 2025. You are getting ready for Christmas. You're checking your 401k, and everything looks fine. The S&P 500 is holding steady, real estate is quiet, and the VIX is sleeping. But 6,000 miles away, in a gray government building in Tokyo, a fuse has just been lit. While you were sleeping, the Japanese Finance Minister, Satsuki Katayama, walked into an interview room and effectively put a loaded gun on the table. She didn't scream. She didn't shout. She simply said two words that terrified the global bond market: free hand. Japan now has a free hand to crush the currency speculators. Why should you care? Because the last time Japan pulled this trigger, we saw flash crashes in US tech stocks, liquidity evaporated from the Treasury market, and Bitcoin nosedived. The Japanese yen isn't just a currency for buying sushi and Toyotas. It is the cheap fuel that powers the entire American stock market through something called the carry trade. And right now, Japan is threatening to shut off that fuel pump. If the yen spikes, Wall Street bleeds. Today, we are peeling back the layers of this Christmas crisis. We're going to look at why the Bank of Japan is playing Russian roulette with the global economy, why the US dollar is suddenly looking vulnerable, and most importantly, how this currency war in Asia is about to hit your mortgage, your stock portfolio, and your net worth as we head into 2026. Welcome to the end of the easy money era. Let's look at the crime scene. It's Tuesday, December 23, 2025. Over the last 24 hours, the Japanese yen has ripped higher, tearing through the markets like a chainsaw. It strengthened 0.7% to hit 155.91 against the dollar. Now, to the average person, a 0.7% move sounds like nothing. A rounding error. But in the world of Forex, where trillions of dollars move on fractions of a penny, that is an earthquake. This move came immediately after Finance Minister Katayama dropped that bombshell interview. By stating the government has a free hand to take bold action, she is signaling that the Ministry of Finance is done playing nice. They are preparing for what we call direct intervention. This is the government entering the market with billions of dollars in reserves to manipulate the price of their own currency. But to understand why this is happening today, we have to rewind to last Friday. The Bank of Japan, the central bank, made a move that confused everyone. They lifted policy rates to a 3-decade high. On paper, that should make the yen strong, right? Higher interest rates usually mean a stronger currency. But Governor Kazuo Ueda, he choked. During his press conference, he was vague. He was hesitant. He refused to commit to future rate hikes. He sounded like a man who was terrified of breaking the economy. The market smelled fear. The sharks, the hedge funds in London and New York, immediately started shorting the yen, betting it would crash because the governor lacked conviction. The yen plummeted. It hit a 1-month low. Now, the Japanese government is furious. The Ministry of Finance is stepping in to clean up the central bank's mess. They are effectively saying, if the governor won't protect the yen with interest rates, we will protect it with brute force. This is a civil war within the Japanese financial system, and caught in the crossfire is the US dollar. You might be sitting in Ohio or Manchester asking, okay, Japan is fighting over its currency. Why does this affect my Apple stock or my Tesla shares? This is the most critical concept you need to understand today. It's called the yen carry trade. For the last 30 years, Japan has had rock-bottom interest rates. Often near zero. Meanwhile, the US has had interest rates of 4% or 5%. Here is what every major hedge fund, bank, and institutional investor does. 1. They borrow billions of yen from a Japanese bank for almost free. 2. They convert that yen into US dollars. 3. They take those dollars and buy US treasuries, or, even better, they buy Nvidia, Microsoft, and the S&P 500. It's free money. It's an arbitrage machine. You borrow cheap in Tokyo to buy expensive assets in New York. This trade is massive. We are talking about trillions of dollars. A huge chunk of the liquidity that has pumped up the US stock market in 2024 and 2025 originated in Japan. But there is a catch. A deadly catch. This trade only works if the yen stays weak or stable. If the yen suddenly gets strong, like it is doing right now, the math breaks. Let's say you borrowed 1 billion yen. If the yen appreciates by 10% against the dollar, you now owe 10% more in dollar terms just to pay back the loan. Your profit is wiped out. You are underwater. When this happens, the margin call comes in. The bank calls you and says, pay us back. Now. What do? You don't have the cash. You have stocks. So, you panic sell. You sell your Nvidia. You sell your US treasuries. You sell your Bitcoin. You sell everything to get the cash to pay back the Japanese loan. This is exactly what happened in August 2024, the Black Monday scare. The yen spiked, and the US market collapsed in a single morning. This is why Satsuki Katayama's comments are so dangerous. By threatening to artificially spike the yen, she isn't just defending her currency, she is threatening to trigger a massive sell-off on Wall Street. Let's get technical for a minute, because the how matters as much as the why. Japan's chief currency official, Atsushi Nomura, said this week that they will take appropriate measures against excessive moves. What does an intervention actually look like? Japan holds about $1.2 trillion in foreign reserves. Most of that is parked in U.S. Treasury bonds. When Japan intervenes, they have to sell those U.S. dollars to buy yen. Where do they get the liquidity? They sell their U.S. Treasury bonds. Connect the dots. If Japan gets aggressive, if they decide to defend the 155 level or the 150 level, they have to dump billions of dollars worth of US government debt onto the open market. Supply and demand 101, when you flood the market with bonds, the price of the bond goes down. When the price of the bond goes down, the yield goes up. US mortgage rates are directly tied to the 10-year Treasury yield. So, here is the nightmare scenario for the American consumer. 1. Japan fights to save the yen. 2. Japan sells US Treasuries to fund the fight. 3. U.S. Treasury yields spike. 4. U.S. mortgage rates jump back up to 7.5% or 8%. 5. The U.S. housing market freezes. This is the wallet connection. Japan's currency crisis is your mortgage crisis. Let's look at the charts. The Bloomberg strategists have flagged a critical level, 156.00. As of this Tuesday morning, we are trading just below that, around 155.91. A close below 156 is a positive signal for the yen. It means the momentum has shifted. The algorithm-driven traders, the robots that control 80% of daily volume, will see this as a sell signal for the US dollar to Japanese yen pair. We are seeing a reversal of the spike caused by Governor Ueda's weak speech last week. The market is realizing it overreacted. Hiroyuki Machida from ANZ Bank put it perfectly. He said, there is a certain degree of caution over possible intervention. That word, caution, is Wall Street code for terror. Traders are terrified to go long on the dollar because they know the MOF is lurking in the shadows. Historically, we know the danger zones. Last year, the Ministry of Finance stepped in at 160.17. Then they hit it again at 157.99. Then again at 161.76. The speculators keep testing the fence, like raptors in Jurassic Park, looking for a weakness. But every time they break through, the Japanese government slams them back down. Machida-san notes that once the yen weakens past 158, market nervousness rises sharply. We are currently at 155.91. We are in the nervous zone, but not yet in the panic zone. However, the trend is shifting. Helping the yen is the fact that the US dollar is getting beaten up everywhere else. The Chinese yuan is rising. The euro is rising. The king dollar trade is unwinding. US Treasury yields are declining naturally because the US economy is starting to show cracks here in late 2025. This creates a double whammy for the dollar/yen pair. 1. Japan is pushing the yen up. 2. The US economy is pulling the dollar down. When these two forces combine, the move can be violent. We could see the yen rip from 156 down to 140 in a matter of weeks. If that happens, the carry trade unwind won't be a gentle stream, it will be a tsunami. We need to zoom out. This isn't just about Japan. This is about the end of the post-pandemic economic cycle. For the last 3 years, the world complained about a strong dollar. The US exported inflation to the rest of the world. Now, as we close out 2025, the tide is turning. The US Federal Reserve is in a difficult spot. If they cut rates too fast to save the economy, the dollar collapses. If they keep rates high to fight sticky inflation, they break the banking sector. Japan smells blood. They know the Fed is weak. This is why Minister Katayama is emboldened. She knows that the US Treasury Secretary can't yell at Japan for intervening right now, because the US actually needs a weaker dollar to help its own manufacturing sector. But there is a geopolitical angle here too. Look at the Asian bloc. The Chinese yuan is leading the vanguard, strengthening alongside the yen. We are seeing a consolidation of Asian purchasing power. A stronger yen and yuan means cheaper energy imports for Japan and China. It helps their economies recover. But for the US, it means our imports get more expensive.